So, hi everybody, this is Hustle Hub. I'm Giacomo. Today I'm again with Darcy Norton. He has already done a video with me. And today he's going to talk about Rogers Sugar. He wrote an article on Seeking Alpha about this company, and he's a contributor on Seeking Alpha. So please, for those who don't know you yet, please introduce yourself, Darcy, and then we'll jump into the topics of the video.
Thanks, Giacomo. So as Giacomo just mentioned, I've been a contributor on Seeking Alpha since February of 2022. I got 3 articles out there. I'm primarily focused on Canadian companies, but I do a little bit of branching out. I have a Master's of Finance from St. Mary's University, and today I'm here to talk about Rogers Sugar. So Rogers Sugar is a small cap Canadian producer of sugar. They trade primarily on the Toronto Stock Exchange under RSI, but they also trade on the American OTC under RSGUF. I would use the TSX listing as it's much more liquid. Their dividend has been stable since about 2017. Before that, it was variable, but it pays out 36 cents a year, which is typically between 5.5% to a 7% yield, just based on their trade range. And historically, they've traded between $4 and $7 a share. And when they've reached either one of those 2 levels, you would have a pretty clear buying or selling opportunity. So I think this trade range is going to break, but I'll get into that a little bit later in the video as to why. So the reasons I chose Rogers Sugar is that they're a very strong consumer staple. They've diversified themselves into the sugar alternatives such as stevia. They're a Canadian oligopoly protected by the government, so they only have one competitor, and that competitor only has a 20% market share, and that's Redpath, those who are interested. They have a very strong balance sheet, and they are in the real asset category. So this is something I've been touching on a lot, that these companies that have their debt backed up by real physical things that you can touch are going to be facing increased demand for them. And those companies that sell real goods such as sugar or water are also going to see increased demand. And this is just as people are kind of getting more and more scared as inflation rises, geopolitical tensions rise. And Rogers Sugar is poised to benefit even further as food shortages increase around the world. And so for those who have been paying attention to the crisis in Ukraine, you might have heard that Ukraine is one of the top producers of wheat in the world, and they're thinking they won't plant this year. Russia and Belarus, depending on the numbers you get, but they're substantial producers of fertilizer, and they have stopped selling to the West. Europe has shut down a lot of their fertilizer plants. And this will affect Rogers Sugar's bottom line, but it'll also allow them to pass that on to consumers. So to really understand Rogers, you need to look at how they make their money. So as I mentioned earlier, they sell a variety of different types of sugar, including stevia, brown sugar, cubes, pretty much any type of sugar you would imagine, they sell it. They are primarily within Canada. It's about 70%, and they also sell to the US and Europe, with a little bit going to other markets, but it's really hard for a company that does sugar refining to sell to other markets because there's a lot of trade tariffs, because countries are very protective of their native sugar industries. And so I don't have exact numbers for every country, but I read a little bit of the US and a little bit about a couple of the European countries, mostly just through the Euro framework. And these countries were only allowing about 1% of the refined sugar to be sold from a different country. After that, they were facing substantial tariffs, so it's very hard for them to make money like that. Rogers has done a good job of buying a plant up in Vermont, so they've diversified a little bit, but it's not enough to make a material difference in their bottom line, in my opinion. They sell about 55% of their sugar to industrial uses. And so, take that as you will. And they've recently expanded into maple syrup in 2017. through the acquisition of maple syrup treats. And that's about 20 to 25% of their top line growth, of the top line revenue now. So I wanted to look who the shareholders were. Usually you can figure out something pretty interesting about the company by doing this. Rogers, their largest shareholders is the Belkin family. They own that through the Belcorp Industries. And Belcorp Industries also owns a large asset manager, well, large for Canada. And so when combined, they own about 20%. And this actually doesn't give them a lot of influence over Rogers Sugar itself. It only gives them one board seat, and Atlantic, a Rogers subsidiary, actually gets 5 of the board seats. So although they have the largest outside influence, it's still Atlantic who gets to really call the shots in the end. And I never really figured out what the real reason for this was. I know they own the Class C shares, which are basically just allow voting rights, but there's no real reason why I think Atlantic should have a right over their owner company. But I guess that's just their agreement. So now I just want to touch on the valuation. And this is where I got really interested in Rogers Sugar in the beginning. So I did a DCF on Rogers, and I got a value of 817. And this is before rates started rising. And this is around where I see the market pricing Rogers right now. And I thought, okay, well, this doesn't really make a lot of sense, because if rates are rising, we have inflation in Canada of between, I don't remember the last print, but it was around 6%. We shouldn't be using a terminal growth rate of about 1.5%. Even if we just factor in inflation, it's going to be much higher than that. So I just increased that by 1% to 2.5% to about where I see the maximum of our Fed's fund rate overnight. The Fed's overnight fund rate going. And with that, I got implied share price from the discounted cash flow of $12 and about 50 cents. So that's almost double from where the stock is today. And I don't think the stock will get to $12.50. There's certain other things that are going to drag it down. But that does look like they could have substantial growth. And there's not a lot of risk to owning this company in the meantime if you don't get that growth. So I thought this is a really good asymmetrical risk opportunity. Another reason why is that you're basically getting a 5 to 7% dividend yield on a company that trades like a bond. So it just trades like a perpetuity. And this bond would have an A credit rating, an Altman Z score of 2.69. And I just think that this is going to go up because they've been allocating well. They've been paying down debts. They're extremely well hedged. So I was looking into all their debt, and they have an average credit interest rate, less than 3% going forward for almost the next 5 years. And they did that all through swaps. So we might see some losses on the swaps in short-term earnings. But if you're just looking for the future, I think Rogers is very well positioned in this way. And then we have the risks. So as I mentioned earlier, Rogers can't grow outside of Canada effectively. They've done a little bit of diversification into the maple sugar industry. They've done a little bit of diversification into America, but there isn't that much room for growth there. There's a lot of entrenched players in the US that they're going to struggle to compete against. They're just way bigger. They'll have the government on their side. So I don't really see that's a large growth opportunity. The Canadian demographics, that's mostly where they'll see their growth. But Canada's not a fast growing company. We grow mostly off immigration. So I don't see that's a very fast revenue growth either. So the only real growth I can see is through inflation and rising food prices. And so one has to keep that in mind, that this is not going to be a growth stock. This is going to be something that grows steadily over time. And that in 2022, we may see it increase to that growth rate, but I wouldn't expect that to last. There's also weather. So if there's a poor planting season, say there's too much rain or too little, then Rogers will have to go into the open market and buy unrefined sugar to ship to Canada because they have already signed their contracts and they have to make that up somehow. And when they go and do that, the companies are going to charge them a little bit more, and they're going to see less profits, as they're not only losing their planting, they're also paying an additional fee to buy the sugar. And then there's cost pressures that are coming. So this is one of those things that's also very well hedged, and I don't see as a significant risk besides the short-term earnings. And I can't predict those. I'm not very good at swaps. But they're mostly well hedged. However, I noticed they weren't hedged into fertilizer prices, and they've mostly done their hedging in interest rates and natural gas. But if natural gas continues to spike in costs, then their fertilizer prices will spike as well. And it looks like Nutrien, which is Canada's largest fertilizer producer, is going to really struggle. Well, sorry, not really struggle. It looks like they're struggling to get their product out right now because Canada's second largest railroad is currently on strike, and they move. Actually, I can't remember the number, but I remember it was a substantial amount of fertilizer every year. And if they can't get that fertilizer at a reasonable price to the farmers, then we might see a spike in the price of sugar as well. So these three could drag down the share price, or they could drag down the company fairly well. I do think the company is pretty well positioned to weather these, and I don't think that they will struggle as much as some other companies. One of the reasons is that they are protected by the government, but these are just things I think it's very important to keep in mind. So, Giacomo, if you have any questions, I'd be happy to answer them.
Yeah, sure. First of all, I'm wondering, since Roger Sugars is involved in sugar, of course, but also alternatives, are alternatives exposed to these kind of risks, like the fertilizers suppliers not being able to supply the product, or any other? Are they exposed to the same risks, and are they exposed in a are they riskier or less risky?
The sugar alternatives. That's a good question. It's a great question. So sugar alternatives, a lot of them are not plant-based. Some of them are. Stevia is. So stevia they would be exposed to the same cost pressures, but some of the other sugar alternatives that you see, I don't know about what it's like in Italy, but some of them over in Canada are actually petroleum based. Okay. So as the cost of like oil and natural gas increases, I'm expecting those to go up as well. So I'd say they are going to be at risk. I just couldn't tell you the extent.
Okay. And yeah, is it a company that could be a hedge for inflation, given the fact that they could pass on to the consumer the cost of the increased, the cost of, for example, commodities increasing in value? Is it something that they can pass on easily to the consumer, or not?
I think that they can pass on. I think it's a good inflation hedge. The demand for sugar is pretty inelastic. It really just stays where it is. And it's going to be one of the things that no one really foregoes. It's something you need in your diet. So I think this is going to be an excellent inflation hedge. The stock might lag and do a little, up and down. But I think overall it's going to be a good inflation hedge, yes.
Okay. And yeah, and so another thing that I was thinking is, are there in Canada some trends that changing diet trends, for example, of using less sugar, that could possibly hit in the long term, in the long term, could hit this company, for example, with less use of sugar, for example?
So I definitely think that it's been more in a general conversation, but I don't hear people talking about it, say, as much as some like the no carb diets and things such as that. In Canada, we're not the healthiest country. We have a larger percentage of the population that's obese. We have a lot of fast food restaurants. We have a lot of sugary treat companies, and maple syrup is, you will find it in every single household. So I do see it as a slight risk. I didn't see it as much of something to talk about because I don't see it as that much of a risk going forward. And I really just don't see people cutting sugar out of their lives.
Yeah. Just to give perspective, because for example, in the US, you see these companies like Beyond Meat that are trying to get a share of the market and taking a bite out of companies like Tyson Foods and other producers and so on. So I was wondering whether it was similar to, if the sugar industry is similar to what's going on with meat, for example. So I'm done with the questions. I think we covered pretty much everything. So if you have anything else you want to say about this company, you're free to do so. Otherwise, I really want to thank you for your contribution today, for all your insight that you shared with us. So thank you, Darcy, for being with us today.
Thank you, Giacomo. I appreciate it.
Okay. So this is it for today. Thank you for watching. Make sure to follow Darcy's articles on Seeking Alpha and make sure to subscribe to the channel. We'll see you next time. I'm Giacomo. This is Hustle Hub. See ya.